Are you facing any post-audit claims? What you should do today on the Savvy Supplier. Welcome into the Savvy Supplier, and thanks for joining us. Our goal is to save you time and money. I'm Al Frank, and I'm here alongside the one and only Boyd Everett. Boyd is CEO and co-founder of HRG, and let me tell you something, he is a walking encyclopedia of knowledge about the retail industry and about post-audit deduction claims specifically. That's exactly what we're talking about today. So Boyd, let's start with a basic definition. What is post-audit?
Good questions. Those of us in the industry, sometimes we throw around these technical terms, so it's always good to have somebody keep me honest and not get too much inside baseball, right, using these technical terms. So post-audit is short for post-payment audit, and what that means is it's a term to distinguish itself from a financial audit, which a financial audit is going to address the financials of a company, publicly held company, usually make sure that everything is compliant with the government and the accounting rules. Post-payment audit is after all of the payments have been made, the dust is settled, you go back and you look at the price, maybe the cost of goods that you purchased and then you sold at retail. Did you get the correct cost? Did you get the right cash discount? Did you get the right allowance? Those sorts of things. So a post-payment audit is essentially you're looking at what happened and what did we agree that was supposed to happen? What did we agree to and what actually happened? And that's essentially what post-audit is in a nutshell.
Well, is there a statute of limitations on these deductions claims, or can they be years and years old?
Well, technically, you can go back usually 7 years, up to 7 years. But the industry, it's usually 2 years, simply because 2 years is a lifetime in retailing. The odds that you're going to have the same buyer in the chair, the same salesperson at the desk, the same people in marketing and supply chain, all of that. And so the closer they are to real time, the better. But by its very nature, since it's a post-payment audit, you're looking back in time. And so you're looking usually back 6 months to 2 years, and usually that's plenty of information to retain and to review and to revisit multiple times often.
What's it like for the supplier to face these? Is it time-consuming, laborious, frustrating?
All of the above, particularly because the people involved typically are looking at forward, right? The folks in finance, they're looking at the current accruals, right? The people in sales, the ones that are making these agreements, they're concerned about next quarter, not last year. So it is one of those things that not only are you looking back in time, but you are looking at multiple sets of data and information and documentation. So you're looking at email, you're looking at the electronic PO and invoice, usually referred to as EDI. You're also looking at the portal data for the retailer, where you have the point of sale information. So you have a lot of data and you have a lot of information. And then finally, the sort of the cherry on top of this headache, right, as it were, to mix my metaphors, it's cross-functional. So you have a deduction. Typically, deductions are worked by the credit collections team. Right. And so they're the ones that are going through and validating whether or not that's valid. If it's valid, they clear it against an accrual, and then they move on. However, in a post-payment audit or a post-audit situation, typically you have an email in the back of the claim as what sometimes is referred to as a driving document, part of the documentation showing that this claim we think is valid because in this email you promised to do X. And so you have a salesperson that is tied to that claim. And so then you have somebody in the finance area that sets up the accrual for that particular promotion. Let's say it's a claim written against a promotion where they were going to get a lower cost so they could lower the retail. And then maybe there were some issues with supply chain. Maybe the merchandise was back ordered and they weren't able to ship it in one shipment. Therefore, the retailer incurred higher costs of freight. So there's several different teams that are involved. And what I like to tell our clients is that essentially post-audit claims are orphans. No one wants those transactions. Those are the transactions that they're cross-functional, and by their very nature, no one wants to own them. Even the people that's supposed to own them, the credit collections team, they are not empowered to dispute them because they don't have access to the email of the sales team, right? And they weren't in the room when the conversations were had. They weren't on the email threads at the time. So it makes it, just by its very nature, it makes it a very, very painful process.
So let's say that supplier receives a deductions claim, and I guess the time clock starts ticking. How long do they have to, research the claim and to decide whether or not they want to dispute that claim?
Well, I often say the first answer, usually when you're dealing with post-audit, it depends. So it depends upon the type of claim. Some types of claim, they're just deducted immediately, and so you're guilty until proven innocent, right? So now suddenly they've taken the money and you're scrambling to try to figure out if it's valid, and if it's not, how to recover it. But in those cases where they don't take it immediately, typically it could be anywhere from 5 to 30 days. And so when you think about it, in retailing, is really nip and tuck, because you have, especially during the holiday season or the summer season, when you've got people on vacation and you may have 2 or 3 people that were part of that conversation around the agreement, getting alignment's really difficult. So now you've got this time crunch, and especially if you're dealing with 6 and 7 figure size claims, it's not trivial. And then if it comes in at the end of the month, then it doesn't even matter if you've got 30 days, right? If it's going to hit by the end of the month, the credit collections team is going to be all over you to get that researched and disputed.
Well, let's say the supplier does make that time frame miraculously, and they want to appeal the post-audit claim. They've decided they want to appeal. To whom are they appealing?
Right. So excellent question. So the first court of appeal is usually to the auditor and their sensibility and their sense of fairness. You explain the extenuating circumstances. Some cases, the auditor may see things differently, may interpret the agreement differently, and may interpret the data of the performance differently than you do. So then the next court of appeal is usually merchandising. And so usually it's your buyer or the buyer's direct report, usually somebody within merchandising, a VP or an SVP. And in those situations, there's a conflict of interest often, not always, but often, where the way in which merchandising operates is that the money that's found, let's say that you're looking 12 months back. Well, that year is closed, right? The financial reports have been issued, everything, close the books. Well, the way a lot of retailers have landed, and this has changed, I've been in the industry for over 20 years, and so things have changed. When I first started back in the 90s, recoveries, the money that the auditors find and it flows back into the retailer's financials, it would fall under other income and earning. And so it was a separate category, and it stood alone, which was great. But about 10 to 15 years ago, a lot of retailers made the case, their accounts payable folks, made the case that really this isn't our money, it's your money. And so they got the buyers involved and said, we're going to give this back to merchandising. Not necessarily out of the goodness of their hearts, or them being a good team player, although I'm not going to rule that out, but because they wanted alignment with the buyer and with merchandising. So when I first entered the industry in the mid-90s, there was always this tug of war with merchandising and the supplier. It was a three-way, and then the auditor. And usually the way the argument flowed was, if the auditor takes this money, that's that much less money I have to invest in the business, right? That was the big term. So we want to invest in the business and grow the business. And the buyer's going to say, okay, so he wants to help, drive the sales and drive my numbers. And so, yeah, even though the claim appears to be valid, I'm going to tell the auditor to cancel it or to repay it, and then I'll expect to have him invest in this current year's business. Well, the auditors got tired of having to continually look at their claims that were perfectly valid in their opinion become canceled or repaid in order to help the buyer's current business. So during the transition away from just the other income and earnings, they made the case that if it flows back into the department after we've paid for our service, after we've paid the third-party auditors, after we've paid our internal auditors and the overhead, you'll get the rest of those funds. Now, coming back to our Court of Appeal, now you have the buyer has skin in the game. They will benefit if that claim is valid. And if you think about it, if they're going to, let's just say, using round numbers, let's just say they have a batch of claims on their desk that's $1 million. And they're in a category where the margins are pretty thin. Let's say it's consumer electronics. How many TVs are they going to have to sell to earn $1 million? Quite a few, right? So suddenly this becomes a shortcut to make their numbers, right? And this would include grocery. Grocery margins are thin. It could be any category. So, and then if this appeal comes in at the end of the month or at the end of the quarter and they're looking at their numbers, really need to make up for sales, they're not going to sell a lot of grocery items and they're not going to sell a lot of canned goods or a lot of TVs to make that up in just a few days. But if they sign off on those claims, then they will. And so I have what I like to refer to as horror stories, and I have one for every occasion. And so this particular one comes to mind. This is about 10, 12 years ago. One of our clients had an email that they forwarded to me, and they were out, and they were a little hot, a little irritated, and they said, "I can't believe that my buyer sent this to me." And it was just a 2-sentence email that said, last quarter's numbers, your last quarter's sales were disappointing, period. I've signed off on all of the post-audit claims on my desk, period. And so it's left to the reader to decide whether there's causality or whether there's two entirely unrelated topics. I tend to lean towards the former, but right, there is plausible deniability, but that right there illustrates how gray this has become because you have people that have skin in the game.
Well, it's an interesting process, to say the least. Since this is not a court of law, who actually bears the burden of proof?
Another good question. So it would be the supplier, right? So the way in which the auditors wrote, at least some of the fellow auditors that I worked with would advise me and encourage me to say, really, sometimes you don't have all of the information you would need. You see something that would raise questions. And so some viewed writing post-audit claims as, we're just asking a question. Well, you're asking a question with a loaded gun because you're saying, it appears that you owe us $500,000 and you need to tell me why I'm wrong. And so sometimes, and even on this side of the business, because obviously I started out on the retailer side working on behalf of retailers. Now we work on behalf of suppliers. So I've been on both sides of the table. On this side, it's become more and more frequent occurrence where they'll tell me, well, really the claim is just asking a question. And you could send an email and ask a question, but they know that most suppliers aren't going to answer an auditor's question, so the best way to do that is a claim. So to your point, you get a claim, they assume that it is going to be deducted. They assume that it's valid, and so the entire burden of proof is on your back, and now you've got 30 days or less to go get all of the data, all of the email archives, put it all together, recreate what happened last year, recreate those agreements. Where did the agreement land? And you have to, and so the burden of proof, it's like getting an indictment, arraignment, and going to trial in 2 days. So yes, using the court of law analogy, it seems like a rush to judgment, sort of Eastern Europe style.
Well, let's say that the supplier is able to document that it is an invalid claim. The claim turns out to be invalid. Is there any penalty for the retailer?
Unfortunately not. The way in which the retailers operate is you can write as many claims as an auditor, whether you're working for the retailer directly or indirectly as a third party, and they don't mind how many claims you send over to the supplier. Being on this side of the ledger, working on behalf of suppliers, that creates a lot of work, right, for the supplier. And so they could spend hundreds of hours researching a claim, whereas the auditor may have spent just a few hours putting it together. So there's a lot of maybe misunderstanding regarding the footprint that the auditor has in the life of the supplier, and it can be extremely distracting to the current business.
Accounts payable auditors at third-party auditing firms, are they some of the ones that are writing these claims?
I would say the vast majority are. It's simply because of the incentives that are in place. Most retailers, if not all, I'm not unaware of any retailer that has internal auditors that are contingency based. They may have bonuses, so there's a bonus in play, but sometimes there's goals like you will hit this number, right? And so, which leads to fundraising, thermometers, and all sorts of nonsense. But on the other side, the third parties, they're all paid based on contingency. So if they don't deduct and not repay those claims, they won't get paid. So if they submit $3 million in claims to you and you end up paying $500,000 and they don't have to repay anything, it's a great day for them, even though it may have cost you several hundred man hours of labor. For them, it's a win.
You know, this is starting to sound to me like accounts payable departments are now involved in generating revenue.
Yeah, there is definitely an anomaly there. When you and I were in college, AR and AP were two separate entities. One was cutting checks, one was receiving checks. And so, yes, you have this internal anomaly where you have a P&L inside of accounts payable. And they're very proud of it, and they like to point to it. And so it is one of those things that once you have a P&L, well, now you have goals, right? If you're just auditing, you're just basically determining, was a crime committed, right? Was there a mistake made, right? But it's sort of maybe it's an urban myth, I don't know, but the whole idea that police departments have a quota for traffic tickets, right? And sometimes it feels that way in certain counties, right? But if you have a quota, right, it's the old Soviet quote, show me the man and I'll show you the crime. So they'll just come for you whether a crime's committed or not. But yes, and so that whole anomaly of having an AR inside an AP is a recipe for a headache.
Well, Boyd, what can we do to help suppliers to prepare for a post-audit?
Well, some of the easy, or not, I shouldn't say easy, but some of the more simple things that you can do, certainly have archives and have archives easily accessible, and make sure that they're on a public drive, because if you have somebody that rolls off a business, even though they're still within your company, if they're on another account, the last thing they want to do, let's say somebody moves from Amazon to Target, somebody has a claim at Amazon, I'm busy serving Target. I don't have time to do research for Amazon. So that's one example. But another example is, what if they leave the company? Well, now HR typically deletes those emails or doesn't grant you access. So I encourage all suppliers to be very careful to archive all of the correspondence to and from their major customers, their major retailers, simply because the retailers are trapping it at the firewall and giving it to their auditors and their third parties. So one, archive your email. Two, make sure your data is accessible, including the portal data, which has the point of sale information and inventory and receiving information, because you need not only the electronic data that's being transmitted to and from your customer, you're going to need what's inside the portal. And as we mentioned earlier, if you're looking at a 30-day timeline, if that data is not staged and optimized for access, you're going to always be chasing dollars. You're never going to be in a place where you're in a position to prevail.
Should retail suppliers just consider post-audit deductions as just another cost of doing business?
No, sir, I would strongly discourage that approach. And sadly, the mentality is there in many supplier and vendor communities. It doesn't have to be. In fact, if you engage in best practices such as we talked about, but also carefully wording your proposals and agreements, we do best practice training all the time for every major every major retailer, every major category, so anything from grocery to electronics and anything in between. And there's different ways in which you would message your promotions, you'd message price increases, price decreases. There's a lot of moving parts. And just by way of sort of cold comfort encouragement is often at industry events, I've had people come up to me and say, what do I need to do to eliminate post-audit deductions completely? And after a while, it became such a common question, and I knew I needed to have a quick and slightly humorous way of diffusing that, because I tried to explain to them it's baked in, right? But then you get into a long story. So now I just tell people, if you want to avoid post-audits, make sure that you never change your costs, never change your suggested retail, never have returns, never have shortages, never going to happen. Anytime anything changes, there's an opportunity for a post-audit claim.
Mm-hmm. Yeah. Well, Boyd, this has really been eye-opening, and I know there's so much more we'd like to share with all of you retail suppliers. One of the ways you can get more information is to go to our two websites. You see them down below, SavvySupplierPodcast.com and HRG-audit.com. Both of these are websites that have great info for you, and both sites also provide ways to contact us if you would like to have some help for your business, especially when it comes to managing deductions and managing this whole post-audit process. HRG has a team of wise, experienced auditors who, well, they're uniquely prepared to help you, and we love to do that. Also, if you have a question for us, if you'd like to suggest a topic maybe for an upcoming podcast, we'd love to hear from you. Our wish for you is this: wiser decisions, fewer deductions. See you next time on The Savvy Supplier.